Today, I want to look at another form of ownership through stocks. Because stocks are not separate from business, they're simply another way of participating in it. When you buy a stock, you're becoming a small owner in a real company, a company that sells something, serves customers, pays employees, and tries to grow over time. So the real question is not whether a stock price will move. The real question is whether the business itself is worth owning. That's where long-term investing begins. Instead of watching charts, long-term investors study businesses. They learn how a company makes money, how stable it is, and how responsibly it's run. They look at what the business owns, what it owes, and how much it earns. In other words, they look at the company's financial statements. And one of the most useful of those is the balance sheet. The balance sheet shows you what a company has, what it owes, and what belongs to the owners. It's a simple snapshot of the company's financial health at a single moment in time. You don't need to be an accountant to understand it. You just need to know what to look for. You want to see whether the company owns more than it owes, whether it can comfortably pay its debts, whether it has enough cash to operate and grow, whether it's financially stable, not just profitable on paper. These things tell you whether a business is built on solid ground or thin ice. You can also look at whether the company consistently makes money, whether its revenues grow over time, and whether it reinvests in its future instead of just surviving from one quarter to the next. All of this helps you answer a very simple question. Is this a business I would feel comfortable owning for many years? That's what separates investing from speculation. Speculation is focused on what other people might pay for something tomorrow. Investing is focused on what a business can create over time. Long-term investors also think about the type of businesses they own. They tend to prefer companies that are useful, stable, and understandable. Companies that provide everyday products or essential services. Companies with clear business models, steady demand, and responsible management. They are less focused on exciting stories and more focused on durable ones. They look for businesses that can survive change, competition, and economic cycles, rather than ones that depend on perfect conditions to succeed. This doesn't mean exciting companies are bad. It simply means that stability, resilience, and financial health matter more than popularity when your goal is long-term ownership. So when you think about buying stocks, think about building a small collection of good businesses. Businesses you understand. Businesses you trust. Businesses you would be comfortable owning even if the stock market were closed for several years. In the next step, we can go deeper into how to read and understand a balance sheet, how to interpret basic financial numbers, and how to use that information to make calm, thoughtful investment decisions. Because when you understand what you own, you reduce uncertainty. And when you reduce uncertainty, investing becomes less stressful, more rational, and more aligned with long-term thinking. That's how stocks become not just something you buy, but something you understand. And that's how ownership, when done carefully and patiently, becomes a practical tool for building wealth over time.